All right, welcome to a DCF valuation model for Taiwan Semiconductor, ticker TSMC. And we are going to see whether or not this company, okay, I don't think it's going to be the next NVIDIA. I'm just going to say that up front, but it is a huge player in the semiconductor space and it's at an all-time high. So I thought in advance of its upcoming earnings, we could just do a DCF model for the company. And last stream, someone mentioned that the audio was a little bit low. Let me know if it sounds okay here in the comments and stuff. But to go over today's agenda, I'm going to go over TSMC situation overview, tell you a bit about the sponsor for today's video, Wall Street Prep, go over trading comps for the company, then build out the DCF, WACC, do mid-year convention, sensitivity tables, so somewhat new. Because I don't normally do it, but I want to do it this time, and then we'll discuss the price briefly. So let's go over the situation overview. First of all, the bull case. As I mentioned, TSMC is a leader in the semiconductor space and is one of the foremost manufacturers of cutting edge, it should say chips, not tips. So if you are wondering what the difference is between TSMC and a company like NVIDIA, you can think of TSMC as a company that builds the chips and just manufactures whatever the companies that it's working with tells them to do, versus NVIDIA is like a designer of chips. So to give you an analogy, if you think of clothing, a fashion designer doesn't actually create the clothes. They just design the clothes to whatever they think is like trendy or whatever. That's NVIDIA. And then an actual manufacturing company where they get the design and build the clothing, that is TSMC. So that's the first bull case. Second, strong tailwinds from continued growth in semiconductors driven by 5G, AI, IoT, autonomous driving, all of the hot tech trends that have been going on in the world these days. All of that really boosts the need for semiconductors, and so just tons and tons of demand. So third bull case, continued production expansion with long-term contracts from companies like Apple, AMD, NVIDIA, and a whole lot more. So that's the bull case, pretty strong bull case, I gotta say. The bear case, geopolitical risks between Taiwan and China, because TSMC is located and headquartered in Taiwan. There's always an issue and tensions between the two countries. If, I don't know, some kind of conflict breaks out, then that's a huge potential issue for the company. Intense competition from companies like Samsung, Intel, and budding competitors like Google and Amazon, who are trying to also build chips in-house as well. Last but not least, supply chain disruptions could affect ability to produce and meet demand, like what had happened during COVID. And that really can affect business, slow down revenue, and that changes your entire valuation as well for the company. So notes and reminders. So it's not available yet, but I was thinking probably good to have some kind of Discord where I can answer questions here and there when I have the time, and then also just, get to know you guys a little bit better in a setting where it's more easy to interact versus like you guys getting on the chats for these streams and stuff like that. I'm setting it up. By the time you watch this, depending on when you watch it, the link may be ready, but I'll be adding it to future videos I make and stuff like that. So hopefully in the next few days or so, I'll have that ready. This model, by the way, it'll be completely for free. I'll also be sending you guys updates on there, whether whenever I do a stream or something, like give you guys advance notice and all of that. Send out my models in the Discord, stuff like that. This model will also be available for free to download after the stream ends as usual. You can look at the description later. This is also a high-level street-based DCF, not financial advice. So street-based meaning that I'm going to be basing the model based on what Wall Street estimates believe the company should be valued at. And I'm not going to be building out my own assumptions or anything like that too much. Financial statement, Excel shortcut, DCF tutorials in the description below. And I'm also working on an investment banking, how to get into investment banking course, which I'm hoping to launch around late fall, early winter. Trying to do it as soon as possible, but it takes a lot of time to do that. So let's now go into, let's look at the stock first. So as you can see, the stock has just been on a rampage. It was kind of, steady for a while. And I actually remember looking at TSMC's financials here and there and looking at it and thinking, this is a really well-run company with solid growth, but especially really, really high margins, because these kind of manufacturing companies, like chips, are expensive, but they're really, really cheap to make. So that's why the margins for this company is so good. I always thought it should be trading higher, and now it recently, after really trading sideways for almost like 3 years, 4 years, really is starting to pick up. And probably a large part of that is probably due to NVIDIA as well. So that's the stock. And let me tell you guys about Wall Street Prep, and which has a hedge fund and buy-side investing certificate program. If you guys are interested in it, they run this program 3 times a year. You can use my code RareLiquid to get $300 off, and also sign up early by the early registration deadline for $200 off. And they run this 3 times a year, so this might be a different date when you click on the link if you're watching this later. But you can basically learn how hedge funds and other buy-side firms approach investing. And Wharton's where I recently got my MBA. There's professors from Wharton that actually teach this program. And there's a lot of, top buy-side shops that really kind of support and sponsor this program. You can kind of see the list here. So as I mentioned, the program directors, Wharton professors, Wall Street Prep directors, keynote speakers, Howard Marks is probably the most well-known out of the bunch here. And he's just like this legendary investor at Oaktree. And I highly recommend, if you're interested in investing, to listen to his podcast. What was it? Howard Marks, something Memo podcast. The Memo. Really, really good insights from one of the best investors in the world. And then they have all these other speakers and people who are part of the team. It's an 8-week buy-side kind of program, 8 to 10 hour weekly time commitment. So you can but you can do it, kind of build it on your own, or you can work on it at your own pace. And you really learn a lot of what you want to learn if you're interested in the buy-side and hedge fund investing. So investment fundamentals, buy-side modeling, thesis development, advanced concepts, and then kind of like a summary at the end. And if you scroll down a little bit more, you can also see that the people who enter into this program are a lot of times people who are actually in investing themselves. So hedge fund analysts, long-only analysts, et cetera, et cetera. And then there's some additional benefits here as well. You can join a global network. So I've actually recently spoke with Wall Street Prep's one of their chief marketing officers, and then someone who kind of is a director at the company. So they're really trying to build out the network if you join one of their certificate programs. And there are in-person events that happen, I think, every quarter or so, or maybe 3 times a year, happening in like New York, LA, all these places. And you can actually get to know some of the people who you take the course with in person, which I think is like a cool plus. There's like a LinkedIn only group as well. You get a certificate, and as I mentioned, networking events. So check this out if you're interested. I'll leave a link, and you can use code RareLiquid to get $300 off. And with that said, let's go into the next item, which is trading comps. So this is the trading comps. Oh, that's the database. So I kind of organize it here. Oops, I guess, is this the right one? Oh, this is the wrong one. Sorry. Don't need this one. Here we go. Okay, so this is TSM compared to a lot of the semiconductor competitors / similar companies. So it's a little bit tricky because NVIDIA and TSM, they're partners. They're not necessarily competitors, versus Global Foundries, United Microelectronics. These are actual pure competitors where they actually produce in-house. I guess Intel kind of as well. But like AMD and NVIDIA are probably the most well-known chip designers and the ones that are kind of most well-known in the media. And you can see the market caps of these companies. They vary quite a lot, and two of Taiwan Semiconductor's largest competitors are actually many times smaller. And we can also kind of start to look at the financials. Well, also first looking at the 52-week high, you can see that a lot of these companies are trading pretty high. NVIDIA, of course, just recently passed a $3 trillion market cap. You recently also did a 10-for-1 stock split. And then you can see the growth. So this is what I was referring to earlier as to why TSM is such a great company. I mean, 20% growth at the company's scale is very impressive. But what's more impressive, this isn't really necessary. Wait, did I delete those? So yeah, growth margin you don't really need to worry about. EBITDA margin is probably more relevant than EBIT margin as well. So let's hide these. You can see even compared to NVIDIA, which is one of the just best companies in the world in terms of growth and margins, TSM's margins are a little bit higher, at least for EBITDA, but does decrease quite significantly for profit margin. But still, one of just, if you compare it to all the other competitors or semiconductor players in the space, really high EBITDA margins and profit margins as well. And if you compare that to the multiples that the company's trading at, fairly low compared to, let's say, NVIDIA, which is trading extremely high right now, 42 times EBITDA for 2024, 2025, 30 times EBITDA. And then PE multiples also extremely high, right? Compared to a lot of its competitors here, like let's say Global Foundries, United, Microelectronics, not even trading that much higher. So it kind of, and if you compare that, this is what you want to do. You want to look at revenue growth, you want to look at margins, and then you want to compare it to how expensive they're trading. And you can see that even with lower growth and lower margins, TSM is trading pretty cheaply on at least on an EBITDA basis, and then also on a P multiple basis compared to at least Global Foundries. So really solid, like not trading at a what do you call it? Not trading at a level that is like too crazy, which potentially means there may be opportunity as an investment. And then premium or discount to historical multiples. This is just comparing, are these companies trading higher or lower than they were 1 year ago, 2 years ago, 5 years ago? And you can see that TSM is trading a little bit higher than it used to be. But, oh wait, is this right? Let's see. Oh, it is right. Oh, no, this should be PE. Sorry about that. So let's call it price over NTM EPS. So yeah, trading a little bit higher than it used to be, but it did recently kind of shoot up. So that's why I also wanted to compare TSM with some of the hottest, largest tech companies in the world, given that the company is trading nearly at $1 trillion in market cap. And a lot of these companies are a lot bigger and higher, or larger, but still actually like somewhat relevant and interesting, right? You can see revenue growth-wise, kind of a little bit, pretty much only second to NVIDIA. Margins-wise, pretty much at the top. And then trading-wise, like pretty cheap compared to the peers here. So yeah, if I had to choose between a company like TSM or Tesla, which has like 9% profit margins, growing at less, but trading at, 43x, 32x, 70x, 51x. Of course, Tesla, you might argue, has a lot more upside potential depending on its products and stuff, but based on what these numbers show, TSM is, clearly just a cheaper-ish looking company with better numbers, at least as of now. So let's now, that was trading comps. Let's now build out the DCF from scratch, as we always do. I'm going to zoom in here for all of you, and let me know in the comments, or in the chat, where you guys are tuning in from, because it'd be great to know. And as I go through the model and build it, I'll answer questions and stuff like that as I normally do as well. So in order to kind of be more efficient, I'm also going to copy paste from an old model for the NVIDIA one so that I don't have to like redo a lot of this formatting. So let's see, today is the 21st. Okay, and then we're gonna need assumptions and our numbers. Oops. All right, so we're gonna change everything here. I'm just gonna delete a bunch of this stuff for now. Okay, I see some in the chats, some questions here. Boccano University, Boccini, I guess. I don't know, sorry. I don't know how to pronounce that, but one of my friends actually from school, Wharton lets you do summer abroad programs there, so I do know that university. And it seems like some links don't work, so I will double check on those. And cool, from Iowa, from India. Interesting mix. All right, so we have our assumptions, and I know like I took the shortcut, but you guys can do it too, because if you download the previous model that I built for NVIDIA, which if you go to my YouTube channel and you go to live, you can actually see all the modeling videos. I recently actually also built an LBO one from scratch, which I know a lot of you guys have kind of been asking me to build other types of models, and I'm going to build more and more kind of complex ones as time goes on. So you can check that out. But if you go to NVIDIA, you can copy paste the one, or you can download the one that I am copy pasting from right now. Okay, so first thing we want to do is get the income statement. Very kind of standard stuff here. We're going to want % growth and indent this a little bit. So Alt H6, italicize it, and then I'm just gonna copy paste this down a few times because we're also gonna want our EBIT and then our taxes. For this, we're gonna want percentage of sales, and taxes, we're gonna want our tax rate. And then let's start I'm gonna call this DCF and connect this to our figures here. And let's see, we're gonna need to make this green because we're linking to another tab. And we're not gonna have growth rate here, but we will starting in 2015. And this will be interesting to see how the company is growing. And as you can see, there was massive growth in 2022, but then actually a decline in 2023, which is interesting. Because if you compare that to NVIDIA, which I'm actually looking at right now, I'll just drag it down here. NVIDIA had a growth rate of, in 2023, 115% versus -5%. That's really interesting. And if I had more time, I would definitely try to look into why there is that discrepancy. Like, why is TMC going down while NVIDIA is going up, or in that year, at least? All right, and then I also really like, wait a minute. Oh, this is why. Wait. I guess I have to do a custom. I like having the percentages when they're negative as with parentheses. Okay, so revenue growth and then EBIT. They're saying this different fiscal years. These are all calendarized to 2012-31. So I don't think the fiscal year is the issue. As you can see here, these are all to December. Yeah. Okay, EBIT. But yeah, if any of you guys have any ideas as to why TSM had a down year, let me know in the chat or in the comments if you're watching this later. Okay, EBIT. Let's see if there's anything interesting going on here. Okay. I'm going to copy paste this formatting too. Oh, is this green? Okay. Then we're going to get percentage of sales, and I'm going to F4 twice in order to, in order to copy paste this later when I need it. You guys will see what I mean. And then taxes. Taxes are here. And then we can divide it by our pre-tax income to get our tax rate. Okay, so and then we see our tax rate is fairly low, maybe because the company is international, also because these companies just do wild things with their taxes in order to just pay as little as possible. I'm going to finish the historicals first, and then I'll paste in the estimates. All right, DNA is right here. And as I mentioned earlier, I anchored this in order for me to be able to just go down and copy paste this. Do this here too. So you can see it'll divide by revenue. CapEx here, and we're gonna make it, I like to keep all my figures positive. Whoa, this is crazy. So this definitely could be a reason why this company is not trading higher. It seems like the company spends a ton in CapEx, like really a lot. And I'm surprised it needs to keep spending this much, because once the company builds out, let's say, a factory to build chips, it should have a lot of the fixed cost kind of built out, right? Like if you build out all these machines, then you should just have those machines, and then maybe make slight tweaks to it. So, but it seems like maybe what they're doing is the company could be buying new land. It could be creating way more of these machines because it's just trying to keep up with demand. It's probably really affecting their cash flow quite a bit. I mean, these numbers are insanely high, and this is actually probably the reason why the company doesn't trade as high as it does. So that's interesting. Will definitely affect our model a lot. And then let's go into changes in working capital. Seems like pretty non-factor almost. Very, very small number. We're not going to have to worry about that too much while we're building the model. And then let's do change in sales, see what we get. I'm going to also copy this formatting. All right, so we're not going to use percent change in sales because it's just all over the place. And so instead, we're just going to use probably an average of 3 or 5 years or so. Okay, so now let's just connect some of these figures to our estimates. Hopefully things are kind of in line so that we know things are kind of somewhat reliable. Wondering if I should. I don't like how many commas there are here, and yeah, I think I want to actually decrease or make this. I guess right now these are in thousands. It's got to be in thousands. So it's about 2.2 billion in revenue. Oh, these are in millions. Oh, wait. Oh, what? Huh. Let me see. No, they must be in millions, but let me double check like exactly how much this company is generating. Oh, NT millions. Okay, that makes sense. What a fact set. Income statement. I'm just trying to check what. Yeah, these are in millions of Taiwan dollars, but we want US dollars. Did I? Oh, dang it. I downloaded everything as Taiwan dollars instead of US dollars. So that means I have to re-enter. Dang it. Yeah, okay. All right, sorry. I'm going to have to re-download these files and then relink some of the figures that I just linked to. I'll do it really fast. And a lot of this is, well, let me think. Would it be? I mean, I could just apply an exchange rate at the end and use the figures we have here, because that would be the same thing. Let me think here. Okay, so the thing I'm debating in my head is there are always like slight exchange rate issues if we don't use the native currency, but it's not like a huge deal, I think. Okay, let me see when we go to the stock trading at USD. $780 billion. Okay, that seems different than what I had here. 902. Maybe it's because it's using diluted share count. Nope, diluted share count's pretty similar. Stock at 173.96, which is correct. Okay, well, actually, let's see what FactSet says. Market cap 770. Because the share count 25934. Okay. This is weird. Well, it's probably using the Taiwan price, and that's why we have these differences, but the difference is really big, so it's causing me to want to just make sure I'm using the right numbers and stuff. TSM is the ADR, 786. 25,933 versus in our comps different figures. Okay. All right, well, first things first, let me make a decision on what figures I want to use here. I guess what I can do is do like a really quick audit of Taiwan to USD. Okay, but actually, sorry guys, didn't expect this. So I just want to see what these figures kind of look like and how different they are. But this basically will say that the company generated 60, wait, that can't be right. Okay, let's look at the income statement here. Okay, wow. 71 billion, $70 billion in revenue. So that is correct. So 66, blah, blah. All right. I think in order to, I don't know, I know it's very US centric of me, but given that a lot of us are just used to US dollars, I'm going to just use US dollar figures. So I'm going to re-link to a bunch of the stuff that I linked. And as a lot of this kind of like lags a bit, so as it's doing that, I will answer some questions that you guys have on the chat. If you want to convert currencies, should you use daily rates for that day or monthly rate? So it depends on what info you have. I would say if you want it to be super accurate, then you would do it daily, but no one's gonna be able to do that really. Okay, so there's the income statement and then cash flow. I also see a comment in the chat. I feel this is an issue for TSMC since TSMC gets all the EUV machines from ASM Holdings. If in worst case China invites someone, China will be able to. Okay. TMC ADR trades at a premium relative to Taiwan shares. How would you factor that to your analysis? That's a great question. I didn't really even know about that, to be honest. I think what I'm going to do in this video is just compare to the number that it's trading at in the ADR. I don't know if I'm really going to make comparisons to the, to Taiwan shares. All right, moving this to the end here. Okay, so, and then now the only thing I need are estimates. All right, let me make sure these are what I need though. I need it in US dollars. All right, I'm gonna eat a little bit too. Okay, so we got everything now. And I'm gonna delete all this. Rename this income statement, cash flow statement, estimates. Go to DCF. Everything's messed up. Go sales. Then go to estimates here, 2024. EBIT. Go to operating income. Taxes. Then tax rate. Gotta make this green actually because we are linking to another sheet. And then DNA. CapEx. Make this negative. And then working capital. Oops. So one thing I noticed is that I think these numbers were a little different, which is kind of concerning, but at least these numbers matched our comps, right? 22%, 21%. So we're gonna go with these figures here. And okay, so now that I've gotten all of this, now what I can do is go to our estimates and get our EBIT for 2024 onwards. So they're gonna be pretty steady, it seems. And now we're ready to just build out the DCF. So since we're gonna use a lot of the same figure, actually I'm also gonna delete these 2 years. Or actually I'll keep it there for now. So don't need to group these, so I'm just gonna ungroup these. I'm gonna add a note that this is USD in millions. Ooh, great call out. Thank you. That's why I said why taxes. This is probably linked to the wrong thing. Thank you. Was going through things too quickly. Let me double check this too. Income taxes over pre-tax income. make this a little bit bigger. All right. What's this? Oh. So now let's build out the DCF, which is going to entail a lot of these numbers that we have here. And it looks like the company isn't going to be it's not going to be too tricky to model out. And it's mainly just going to be, we're going to be focusing on EBIT, revenue and EBIT as we normally do. So we're going to have a conservative case, base case, which is going to be based on the street, an optimistic case, and we'll probably just build out a 5-year DCF. 10 years, too much can happen. Connect these to the figures we have here. Since it's linked to the same sheet, make it purple. For EBIT. And then same thing for tax rate. All right. Guess we can, I'll just link up here. Make it easy. Whoa. Oh. Connect this to our EBIT margins over here, and then tax rate up here as well. One last thing I want to do is I want to make the percentages in parentheses if they're negative numbers. Oops. Cool. So now let's look at the numbers here and kind of figure out what makes sense for our estimates. And we can see that for 2024, 2025, the street estimate is around 22%, 21%, pretty solid growth, and then 15%, but these figures not super accurate usually because a lot of brokers drop off. And this is kind of honestly a little weird to see street thinking for the next 2 years. It's just going to be steady at 21 and 22%. But 2024, we have, as of the streaming of this video, we have 6 months left, and there's going to be, it's not going to be too different than this 22% probably. It might go up like a little bit, like 1 or 2%, or down 1 or 2% in all likelihood. And then 2025, there will be a little bit more variability. But I think what we can do is kind of go with these 2 years for the next 2 years, because I think the street has a lot of visibility over this next 1 year and a half. So let's make these. Let's go with the street case for the first 2 years here. And 15%, I mean, this actually, normally I don't want to rely on this, because if we go to outlook for the company, you can see for 2026 revenue, actually there's a decent number of brokers, but still should be a lot less than 2025. Yeah, I guess it's not that bad though. Versus 2024, there'll be like even more, actually similar to 2025. So actually, compared to other companies where a lot of brokers just drop off, for TSMC, it seems like there's not that many that drop off. So actually, compared to other models built in the past that I've streamed, where I don't take into account this like 3rd year, I think I am okay with it here for this one. Because it's better, like I'd rather base it off of the street than for as many years as I can, where it seems somewhat reliable, versus me kind of changing the numbers on my own and, you know, decreasing it by a certain percent, because, you know, that's like an estimate. We're always like creating a range to see what you need to believe in order to think that the company is valued at a certain amount. And so I always do have to eventually make some decisions here, but then if as much as we can rely on the street, then, you know, that's good for, it's just more, it has more foundation, I guess, to rely on. So, okay. 2027, 2028, got to figure out what to do here. And I think what's tough is that normally it'd be great if this was a company where we can go to comps and then see, okay, this company is, you know, it's growing, but it's at like a certain size, and we feel like the company can ultimately grow into something like NVIDIA, but NVIDIA is growing at these like crazy percentages, right? So then, and so like you can't really look at a company that's bigger and say, oh, I think in the long run, the company will steady out to like this percentage. And there are times where, you know, the company can grow pretty crazy amount, but there's also times when, for whatever reason, the revenue can drop as well, right? So you kind of want to account for all of that. Let's see how much of a decrease this is. Like a third decrease. So I think that kind of makes sense. We can just decrease these last 2 years by a third for 2027 to 2028. So let's call it 27 to 28. Oops. And we're going to decrease it by 33%. We're going to multiply these by, oops. Actually, that was right. So this times 1 plus the metric here, which will get us to basically 66% of 15%. So growing from 22, 15, 10, 7%. I think that's pretty fair. And then let's think about our conservative and optimistic case. So 2024 should be pretty accurate. $2025. Basically, what I want to do here is kind of like decrease this by a few percentage points and increase it by like not that many, but maybe like 1 percentage point in these years. And then I think this 21%, you know, a company growing at the same rate when it's that size is kind of unlikely. But I mean, it's possible, but unlikely. Like, I don't know why estimates are this way. Maybe a lot of the long-term contracts that the company has gives analysts a visibility into where they think TSM's revenue is going to grow next year. And it's, you know, maybe it's like they're building up capacity, production capacity, and so revenue is going to like jump. That's very possible, actually. But I still would want to decrease these a little bit. So let's see, for 2024, I'm going to move this down. 2024, I want to decrease it by 5%. See where that gets us. And then optimistic scenario, increase it by 5%. And actually, let's do that for 2024 and 25. So what we're going to do here is get our base case and add our assumption here. Press F4 to lock it. So yeah, it goes down to 20.8%, 20%. I think that makes sense. There shouldn't be a huge difference for these first 2 years with the street. So I like these. And then now we can just kind of think about what about these next few years. And this is where I think we want to have more variability, because there will be a lot of variability. We just have no idea. Like if you just look at these numbers, they're all over the place. So I think what we want to do for 2026, 28 is have a 10% difference. So let's go 26 to 28. Negative 10%. And then here, increase 10%. And I'll just move this up there. Okay. So we're going to get this times 1 plus 10% here. And then this times 1 plus 10% here. This isn't like a crazy range actually. So I actually want to see what it looks like with a 15% difference. Okay, I kind of like this more because then it gives us a broader range when we are ultimately calculating our share price of what we kind of will need to believe, right? And I think having more variability is good in this scenario. So now let's just build out our switch. So offset with our revenue switch, 0. Make this black. Oops. We forgot to anchor the switch. Multiply our previous year times 1 plus our growth rate. That gets us our revenue. So that is pretty much the hardest part. And now we can do our EBIT, which I guess is like the other slightly hardest part, but not like too bad. What I think is interesting here is that the margins have consistently been pretty good for the company, around like, 38, 40% EBIT margins is very, very solid. Has gone up at some point to 50%, and then now the street is thinking like 42, 44, 45%. I think we're going to follow a similar pattern with what we did here for revenue. I'm going to just double check though on FactSet to see how many brokers there are for 2026. Still decent amount actually. And then I'm also curious what the non-GAAP looks like. So 50 something billion. Okay, not that much more. Oh, there's only one person. So not really even that relevant. Okay. So we're going to do something very similar because it just works for this, for the numbers we have here, where we're going to rely on the street for the first 3 years and then kind of like decrease them for the next 2 years. So just pretty much the same thing what we did, we're going to do for EBIT. So, but this time, I guess, oh wait, actually we can't do the exact same thing. Yeah, we actually can't. Let's see. So basically the company is going to increase margins to 45%. Like I don't want to grow it too much more for our street case, because typically when a company is very mature, you can actually just assume that the margins are going to stay pretty flat. And in this case, in the next 3 years, we're projecting that the company is going to increase its margins slightly. But still, like, to maintain these margins is still pretty good. And these are higher than pretty much, besides the past 2 years or so, pretty much the highest the company has ever achieved. So I think for our street case, where we want to still be a little bit on the conservative side, it makes more sense to me to just keep it flat for the last 2 years. But I guess what I can do is I can make it a little bit more variable or dynamic by having a switch here. I'm just going to have it as 0% for now. So later on, like if I wanted to increase it by a certain percentage, then I could, but for now I'm just going to keep it flat. And then for the conservative case, we'll do something similar to what we did for revenue, where depending on the years, we'll decrease or increase by a certain percent. So let's call it 5%, negative 10%. These are going to be too much. Margins are not as, they don't change as much as growth rates. Okay, so let's see where this lands us. So we're going to get this multiplied times 1 plus our figure here. And then this times 1 plus our figure here. And then this one we want for 2026. This one we want for our optimistic one. All right, let's see where the numbers land us. Okay, so let's see. So I do think our optimistic scenario is very optimistic, growing to 47%, staying flat. Also takes into account, like, some years maybe it's a little bit lower. Sometimes it's like 50%, like it achieved in 2022. For our conservative case, little bit weird because we're saying it goes from 41% to 43 and then down to 42 when companies usually go up. So I'm going to make this go up to about like a little bit more. Wait, this side. Let's see, be like negative 4%. Basically, it's going to just stay flat at 43%. I think that's a good conservative case. I think later when I actually am looking at what case to use, like what I'll probably end up using is this street case. I think this is a lot more fair versus the conservative or the optimistic case. So now let's build out the switch. Okay, so now we have our EBIT. Taxes, I'm not going to worry too much about because, you know, they're just in the teens. I think, you know, it has gone up in 2023 and maybe the company will start paying a bit more. I will just use the average of their last 5 years and keep it flat. I'm going to make this red because red indicates that you're doing something like honestly just a little weird, which is weird, right? I'm just like calculating something here. So that's our tax rate. These taxes are actually going to be different than what we calculate here. This is just going to be EBIT times 1 minus the tax rate. Or later on when we get to, for our unlevered free cash flow formula, it has to be EBIT times 1 minus tax rate. So, oops. Let me think about this. Let's see, earnings before interest. Earnings, EBIT times 1 minus the tax rate. Yeah, so you want to times EBIT times your taxes. Yeah. No matter how much I do this, sometimes, you know, I'm rusty from time to time and need to think about things. Okay, so now that we are done with a big chunk of it, let me see if there are any questions in the chat. I'd like to get your thoughts on Intel. I don't know too much about Intel, but I know they're behind in terms of being a chip designer compared to NVIDIA, and they're trying to like catch up. So I guess like TBD on them. Do you think an average for the 3-year estimate based on street estimates will suffice? Do you think an average for the 3-year estimate based on street estimates will suffice? Not sure what you mean by 3-year estimate. Maybe you mean the latter 3 years. But it's not really about like how many. Well, 5-year DCF is very commonplace, and so I think it's totally fine. Like we are in the first 2 years, depending on the street a lot, but ultimately we are going to be building on like a 4.5 year years worth of projections. In your experience, how often did you use ER or FactSet versus the art of figuring out the model, averaging last 3 periods, or plugging numbers based on previous public reports? So on the job in banking, you build out usually for a client 2 types of models. One is the management model, and then one is the street-based model, which is what we're doing here. Street-based model is you use what the street estimates, and then the last few years, based on what you think makes sense, you just like kind of project out on your own, because the street doesn't always project, 5 years for your companies reliably. And another thing that we did on the job that is different from this is that, you know how I went to FactSet earlier and then I showed you these brokers, and right now we're just using an average of all these brokers. But what we used to do back at JPM is we would choose the best brokers that we kind of really believed in, and chose, let's say, like 5 to 10 of them. And this is for like where a deal where we have to be really, really precise, and versus kind of more just like off the cuff type models we could do for marketing work. Like this is for like a live deal. So let's say we choose 5 to 10 brokers or these kind of equity research or these banks, and then we choose the 5 to 10 best ones. We go onto Bloomberg and download, or we go onto Bloomberg and or download the equity research reports and literally find the figures and hard code them into an Excel. so that we are making sure that we are not just pulling from something like FactSet, which always has like mistakes, but always is accurate and is using what the street, like what we think the best brokers are predicting. And then we would do that for all, let's say, like years that they're projecting. And that way we always know that everything is very consistent. Versus now, you know, we're looking at like 20 brokers here, and then 2025 is like 18 brokers maybe, and the 2026 is like 10 brokers. So that is what's a little different, but roughly speaking, this is kind of like the same thing. When it comes to an acquisition schedule and an LBO, do you make an initial year adjustment or pull in the financials in the year you make the deal? So if you're acquiring a company while also building out the LBO, I mean, to do it properly, you'd want to incorporate the financials on the date that you want to incorporate them on the date that you acquire the company, and the two are one, basically. That's how I would kind of think about it. Why don't you project out revenue for each type of TMC node? Because you need to have very, very specific kind of information and data for that. And I don't really have that information. Like, I don't have accurate, reliable information. So that's why this is like all very high level stuff. Also, I have 2 hours usually that I budget for these videos, you know. I'm not trying to spend my entire Friday afternoon doing this. But hopefully it's still helpful enough for a bunch of you. Okay, so I'm going to connect to these percentages. Actually, I can just copy paste this. All right, but this is going to be a little interesting because usually a lot of the companies I've been modeling out for, the DNA and CapEx are not that big, because I do typically model out for larger companies, and usually like their CapEx is probably like anywhere from like 5 to 10%, DNA somewhat similar. But in our case here, company is still aggressively expanding, although slightly decreasing this past year. I think normally I kind of rely on historicals, but in this scenario, it'll be very helpful to see what the street thinks if there are estimates. So I'm going to go into here, capital expenditures, and hopefully there are estimates. Yes, there are. Awesome. Okay. So I'm going to actually download these. Because these numbers are, you know, like they can change so much. Like it's just very helpful to have numbers we can use versus me trying to just base off like historicals. Okay, that was weird. Okay, I'm going to save this file in case anything weird happens. And this seems like it's not needed. I don't know why I wasn't able to download that, but give it a try again. Okay, sweet. So these are all estimates. I'll just say, I'll just copy paste this over here. All right, so I'm going to use the estimates we have for 2024 to 2025 here. So let's actually go back up here and then link to our estimates, CapEx, Yeah, this is what I want to see, because basically a lot of times I'll use CapEx historical percentage of sales, and then it'll be kind of like it should be pretty flat or whatever. Like if I were to use the historicals here, like an average over the past 3 to 5 years, show you an example, like 3 years, it's going to be like 48% of sales, right? Which is just way too high. You don't expect a company to be increasing in percentage of CapEx as the revenue increases. So this makes a lot more sense to me. Still is relatively high, but it's fine. But actually, now that I think about this, how should we actually do this? Like the one option is connecting to the actual CapEx. The other is applying a percentage depending on how sales grows, because for this company, since it's a manufacturing company, your CapEx should be increasing as your revenue is growing, because in order to grow your revenue, you're going to need to probably invest more into CapEx. So we can either take the percentage of sales here or the actual figures. But I'm going to go with the actual figures, because analysts, this is what they believe, this is what they project, and I think that'll be more accurate than using a percentage. So I'm going to make this red. Oh wait, no. Let me just make this purple. It's all the same thing. And let's get this as a percentage of sales. Okay, and then, I mean, this is quite a decrease. But again, you don't really expect a company to be investing like 40% of revenue into CapEx. That's just crazy. So I guess this might be a little bit low. 35, 33, 27. I mean, this is what the street expects. I'm kind of just thinking, okay, maybe we just keep it flat for the last 2 years then, 27%. This might mean that we're not being like super conservative, which you typically kind of want to be when you're modeling. But I guess we just go with what the numbers say, right? So this times this. This is a very kind of weird line that we were modeling out here. I might change this, because for our DNA, also, I guess like it's been pretty stable at around 20-something%. I guess also this would be good if we had numbers for it, instead of me using historicals only. DNA tends to be not as well. Oh, here it is. Wait, I think I have, but it's coming from the income statement. Okay, let's double check this. So DNA 2023 was 16,847. Slightly different. 14,343. 15,1. Okay, at least it's close enough, I guess. There's always, you always want to take your, oh, actually I should be checking it to this. 17,073. DNA. Okay, yeah, 14,344. So yeah, it's a little bit different, but not hugely. You do want to ideally get your DNA from your cash flow statement instead of your income statement, because the income statement sometimes just doesn't capture like everything. But I guess it'll have to do. Or I think what I want to do is just actually get the like fact set. Sometimes it's not as easy to just find it in the thing I just showed you. Like sometimes, but you can just download the actual figure. So let me do this, and then you want to go to estimates, consensus, and what we want is depreciation and amortization. Mean annual year is the year that we're in. Okay, currency. Okay, 2227. Is that the same thing here? DNA. Okay, I guess it's the same thing anyway. All right. Get rid of this. Okay, so this, if I refresh it, okay, it's loading. FactSet always takes forever. All right, so we have our DNA. I see a question on, oh, mic is way too low. So I'll try to keep closer, but hopefully you can raise the volume and then it'll sound normal-ish. I'm also going to make these as values. Okay, so we have our DNA now. Then we need to also do this as a percentage of sales again. So 24, 23, 23%. Okay, I like this because, again, we're not relying on, sometimes historicals will be, sometimes historicals, you can't really rely on them too much because like they can be all over the place, but I'd rather like us use numbers from analysts versus us kind of using whatever we think makes sense, or historicals at least. And then I'm just going to keep it flat in the last few years, then multiply this by sales. So again, if I have to critique anything about this model, it's going to be, for this company at least, because we're doing things pretty differently, the CapEx is decreasing quite substantially versus the DNA, which is like kind of, I mean, ultimately you do think you always want to see your CapEx and DNA converging over time together, but it is kind of converging very, very quickly in these last 2 years. All right, so now let's calculate our net working capital. I'm just going to take an average of the past 5 years, and it's going to be pretty, not like a huge part of the analysis, so I'm not worried about it. Get this, multiply by our sales. All right. So now we have everything we need to calculate our unlevered free cash flow, which will be our, the formula that everyone always knows is EBIT times 1 minus tax rate plus DNA minus your CapEx minus your change in net working capital. And then we're going to need our present value of free cash flow. And to do that, we're going to need to calculate our WACC, which is also, I think it's going to be tricky again for this company because WACCs are, I don't know, it's changing so much all the time with like the interest rates going up and down. It's hard to really know like what these super large, very financially safe companies, like what their WACC is based on like this formula that we're going to use. Okay, so what we're going to do is just fill out the information one by one. So let's see, just delete all this stuff. Okay, so we're going to go into market cap, find the company's market cap. $787.6 billion, fully diluted 787.6. 787. We don't want things in billions. So we're going to do that, hard code that there. Cost of equity, so risk-free rate, we're just going to go to 10-year treasury yield. So this is basically if you wanted to invest your money in a very, 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 very safe financial instrument, like what would that be? That's your risk-free rate. And the US government likely not to default, likely won't default. Beta, go down here. You can also find it on Yahoo News or Yahoo Finance or Google Finance probably too. Beta here, 1.59. Market risk premium, gonna go to this New York University NYU professor who, for whatever reason, calculates this like every month. He does just like a public service. I don't know why this is lagging. Okay, it seems like the stream froze for a little bit, so sorry about that. Okay, so let's go down to applied equity risk premium, June 1st, 4.12%. 4.12%. Cost of equity is your risk-free rate plus your beta times your market risk premium, 10.8%. Debt, let's see if the company has any. It's like we're going to have to go to the latest the annual report. Oh, this is super zoomed in. All right. Financial statements, down. Okay, this looks like what we need. Okay, current assets, non-current assets, liabilities as of December 31st, 2023. Let's see if they have any debt, bonds payable, long-term bank loans. Looks like they have 2 tranches of debt. Current portion, this could be debt, so I'm gonna have to search for this. Is this, wait, let me check, is this stream frozen? Oh wait, just kidding. I think it's working. Let me know in the chat though, because YouTube on my end is saying that the video's not maintaining smooth streaming, but okay, cool, not frozen. Sweet. So now, okay, let's go to that again. Oh, it's in the notes. Oh, it has notes for notes here. Okay, so I guess we go to note 18. Okay, it's not that easy to find, I guess. I used to do this quite a lot. Oh, here they are. It's like you need to find something, but then you don't know where it is, and you just like find it by pressing enter a million times. But it should be somewhere here. This is note 6. We need 18. It might not be my mic. There's just times when I'm just not speaking very loudly. All right. So here's bonds. December 31st. All in NT. Okay, interest rates. 0 point something to something percent. Oh, there's a lot of info here. Okay, long term. Okay, current portion. Current portion. Okay, so it seems like what's on the balance sheet, the long term, or the current portion of long term liabilities is probably the debt. Okay, and then the annual interest rate for the bank loan is 1.15 to 1.35%. So average is probably like 1.25%. Okay, good to know. Okay, F44 is where the page is at. All right. So what I'm going to do is get this figure 303.5. Best practice actually always like copy paste it, because you may think that you will always enter it correctly, but you will always make a mistake. 303.5 plus bonds payable. Oh, whoa, this is huge. Then plus 143.1. So 30 billion. Is that right? 30 billion? Millions. Yep. 30 billion in debt, which is not that much because the company has market cap of like 800 billion. But let's calculate. So the total here is just market cap plus our debt. And then our percentage of equity is that divided by the total. So cost of debt basically is going to be like nothing. Tax rate, let's just use the latest year, 2023. And then cost of debt, I always take a shortcut when we're doing this because just can't be bothered with calculating this, but let's see. So bank loan is like 1.25%. And then the bonds are just all over the place. So total is domestic unsecured, overseas unsecured. Domestic terms are here. So very, very low, basically. Zero, basically free. It seems like Taiwan just gives out like free money. Like 0.5% to like 2%. And then it gets, I guess, a little bit higher. Probably as interest rates went up. And then 2.7%, 3%. 1 point, okay. And then this is the unsecured overseas, which is 1% to about 5%. So, and these are amounts are roughly the same. Okay. All right. Well, I'm just going to call it 2%. I mean, you guys can audit this later if you want, but this is barely going to change our WACC at all. So percentage of equity times, so now we're getting our figures here. So WACC is percentage of equity times cost of equity times percentage of debt times cost of debt times 1 minus the tax rate. 10.47%. So let me just show you, even if this is 1.5%, 2.5%, it's going to increase or decrease it by 0.02%. So that's why I'm not really going to worry too much about getting it super, super accurate. Although, like, it's really not best practice what I just did, like eyeballing. All right, so 10.5% WACC for this company this size is actually, I'd say, high, because a company this large and this stable with these good financials can get access to capital very, very cheap. But you know, that's also with like a lower interest rate environment. So, but I'd say like this is roughly a 10% WACC is usually a WACC for a company that's kind of a moderate size. So 10.5%, I think I wouldn't personally really use it when we're figuring out our numbers here. I would probably use something less, like almost like maybe 9.5% even. I kind of think 10% is probably a bit too high, but anyway. So that was a huge digression. I'm going to call this WACC. I'm going to call this TGR. We're going to use a choose function, get our number here, and then have it choose amongst the cases that we built out here. Same thing here, except conservative will be 2% terminal growth rate, 2.5, and then 3%. So now we have what we need to calculate our unlevered free cash flow, which is your cash flow time divided by 1 plus your WACC to the power of the year that you're in, which we didn't do yet. So discount period, let's call it mid-year discount period. Forget what I called this one. A period and discount period. So we're going to do mid-year convention stuff here, figuring out our periods and all that, because basically we have 6 months-ish of the year left of 2024 as of June 21st, 2024, when we're filming this. So when you are projecting out free cash flow for DCF, you always want future years. You never want you don't want a cent from the past, even if it's yesterday. So to figure that out, we first want to figure out how much of the year do we have left. So that is year frac start date, which is today, and end date, which is the last day of the year. So we have 0.53 years left of this year. And what bankers just assume is, well, when you're getting your free cash flow every day, you should be discounting it back per day, I guess, if you're projecting into the future. But no one has time for that. No one has information to do that. So what bankers do is they just say, okay, let's just do a simplifying assumption that we're going to get all of our cash flow in the middle of the year for whatever year that we're in. So at this time, from now until the end of this year, we're going to assume that we get it in the middle of basically 0.2, basically this divided by 2. I don't know, my computer's lagging now. Something turn on. Okay, I think it's fine now. So basically we're assuming, okay, we're going to get our cash 0.26 years from now in 2024. And then for the future years, what we want to do is assume we get all of our cash at the end of June, in the middle of the year, which is June 30th, 2025, 2026, 2027, 28, etc. So the way we do that is we figure out how many years, well, let's do this. So we have this many years left, and this gets us to the end of 2024. And then if we add 0.5 years, then that gets us to June 30th, 2025. So that's how much we want to discount in that year. And then at this point, we just add 1 because we're already at June 30th, 2025 here. And so we add 1 year, and then 1 year and 1 year, etc. So I'm not going to go over that too much more because I've gone over it a lot in previous models as well. So now what we want to do is get our unlevered free cash flow 1 plus our WACC to the power of the year that we're in. And so as you can see, like let's say this is 5, this number decreases a lot, right? So having just that getting that assumption that you get all your cash in the middle of the year does make quite a big difference. So that is pretty much our DCF, and we're almost there. Now we're going to need to find out our terminal value, present value of terminal value. Then we want to get our enterprise value, then subtract debt, add cash. That gets us to our equity value, and then fully diluted shares outstanding, and then implied price per share. Terminal value is going to also be very simple. We're going to use the perpetuity growth rate. So that is your last year's free cash flow times 1 plus your terminal growth rate. All of that divided by your WACC minus your terminal growth rate. And then we're going to find the terminal value of this, which is 1 plus your WACC to the power of the last year of your projections. And then enterprise value is the sum of your present value of free cash flow and then your terminal value, 603. This looks pretty low, a lot lower compared to what we know the company's currently trading at. Then we got our, but we'll look into that a bit later. Let's go to our company's cash balance. So cash and cash equivalents. pretty much all we're going to need. Yeah, so 47-ish billion. Equity value is our enterprise value minus our debt plus our cash. And then our fully diluted shares outstanding is on FactSet here, which says 25,934. No, that's wrong. This is the number of shares for the company. But there's probably a different share count for the actual ADR. Where do I find this though? Let's see if it's... I'm sure there's an easy way to figure this out. So, I mean, this, okay, per par value NT were, okay. Let me Google this. TSM stock. So basically what this share count is for the Taiwanese stock or whatever, and then there's an ADR share count that we need to find. Never really looked for this before though, so I'm gonna Google it first. TSMC ADR share count. 5.2 billion. Okay, here's one figure, 5 point something billion. I want to find the actual number too, though. I don't know if it'll be in here. I mean, it's a random website. I don't know if I want to use this. But I guess all the companies they're all saying the same number, I guess. Okay, no, it's gonna take forever. All right. Let's see. 5 point. Okay, I think this number is just correct. I mean, it's got to be. There are so many companies saying there's 5.19, so let's go with this. Okay. So since everything's in millions, there we go, $120. This is basically what we've been looking for. All right. So if we go to our agenda, so we've finished everything. I said we'd do sensitivity tables before price discussion. So let's build that out real quick. Won't take too long. I'm sorry, my computer is lagging a ton. So sensitivity analysis. What can we drive? WACC versus terminal growth rate, very common one. We actually, excuse me, don't have a ton of like huge drivers for the company. So I guess this revenue just does change a lot. But WACC and terminal growth rate will be the most relevant. So what we're going to do is get our implied price per share, make that equal to here. And then on the bottom here, we're going to have our WACC. And then at the top, our terminal growth rate. I actually haven't done this in quite a while, so hopefully I remember how to do this. So we're going to make this equal to our WACC. And then this plus, or as we're going up, equals this minus 0.5%. Oops. And this plus 0.5%. I think I remember actually. You have to have to hard code something. I can't remember, but we'll give this a try and see if everything works out. These numbers are also really funky looking, so I'm just gonna call this. I'm just gonna hard code this instead of linking to our WACC. It's pretty much 10.5% anyway. No, I do read the chat. Hard code WACC. Okay, I guess what I was saying just makes sense. So we have the figures here for WACC, and we're going to do it for terminal growth rate as well. Okay, and then what you do is you select these cells and then you go to data, then what if analysis. Then there's something called data table. Then the row input cell is this row. So you go to terminal value. Click on this. And then column is your WACC here. And then this is your data table. And just so you guys know how it's formatted at, oh, I shouldn't be using my mouse. In the job, you want to format this by making this cell white so you can't see it. Or actually make it the color of the chart. Here, so let's move this down here. Usually make all of this gray. So a lot of you guys probably is going to be very irrelevant for you actually, but I'm just going to format this in the way that it normally is on the job. So you make all this gray, then you make the font color of this the same as that gray you just used, so you can't see it. This, you can either merge, or it's better practice to center across selection. And then you add a border here. You also want to center this across selection. But you also want to like rotate this. So maybe I can't do that like that. I forgot how to do that actually. Why isn't it letting me do that? Oops. Oh. So rotate this 90 degrees. But let's try centering this now. Nope. Okay. It's going to merge. And also usually you move this to like over here where you can adjust the column sizes to however you want. So let's move it here. So, you know, there's cells here that if you change the column size, it's going to change everything. So that's why usually sensitivity tables have like their own little section. So I can change this column, for example, to size 5. Make these a little smaller anyway. Oops. Okay, so this is pretty close to how I would format it on the job. Let me add a few more borders. And as you can see here, so basically what this does is it shows you if your WACC is lower, what will your your implied share price be? If your WACC's higher, or your terminal growth rate's higher, you expect your implied price per share to increase. And then if your WACC is higher, you expect your price to decrease, right? So, and in the very middle is what the number you should actually be getting, which is 119.39. So you can follow the same process I just did, but use different assumptions here. Like you can use like a different growth rate if you want to use like revenue growth instead. You can basically, whatever assumptions are driving your model, you can use these numbers doing this throughout using the same process. So yeah, I know that's not relevant to everyone, but you know, maybe some of you. Implied price per share. Now let's actually talk about like what we are getting here. So current share price, implied discount, upside versus downside. So implied price per share. $119.39. Current share price is 173.96. Wow. We're like way different. Implied upside versus downside. Wow, this is crazy actually. Normally, I did not expect this much of a difference. But I do remember like we're a little bit conservative in some areas, but this is our street case. Like I think what I would definitely change is the WACC. 9.5 again could still arguably be a little bit on too high. So let's call it. I'll actually even argue that it'd be even lower at like with the current financials of the company. Optimistic. What do we use for NVIDIA? I think it was like 8.5% or 8%. Yeah. NVIDIA is obviously a lot larger and dominant, so don't want to be too much higher, but let's call this 8.5%. Keep this at 9.5%, 10.5%. But I do think this a lower-ish WACC does make sense, but you could argue it maybe like it should be in between the 8.5 to 9.5%. But yeah, we are massaging the numbers here quite a bit. But let's see, if we were to look at the very, very optimistic scenario, then it shows that we have an implied per share price of 189.19. If we just look at the street case, then 22% downside, and then on the conservative side, 41%. So generally with this range, what I feel like this is telling me is that the company is trading a little bit high, and it definitely is going to have to execute perfectly, as so many companies are these days, in order to justify any more potential upside. I think one of the largest reasons the company's share is trading at such great multiples is because, at least for EBITDA, you don't subtract out your CapEx. So then it looks like it's trading at a better price, but it doesn't take into account how much CapEx spend there actually is. Like, I think if you go to NVIDIA, for example, CapEx is not really decreasing the company's future free cash flow by much at all. Whereas for TSM, it is decreasing it by quite a bit. Even though it is being offset by DNA, there's still a lot of cash being spent on CapEx, and so that means your free cash flow is just not going to be as strong. So actually, I'm really glad I built this out, because I was wondering why TSMC is trading at such a discount compared to a lot of its peers, and that really explains a lot. I think given the numbers here, like what I would kind of assume, if we look at the numbers, like I think our revenue optimistic scenario is maybe a little bit on the conservative side. So like we're not like increasing it by a ton. So I think it's reasonable to assume the optimistic case for revenue. For EBIT, 42 to 45 and staying around 45, I feel like makes sense. I would either use the base case or the optimistic case. WACC, I would use our optimistic case. So that really pretty much gets us to a 4% downside. And, you know, of course the stock can keep rising and go higher and higher. But for me, it seems like the stock is pretty fairly valued at this point. And what'll just make me wrong is if revenue growth is a lot higher than expected, because we didn't expect NVIDIA to be growing as much as it did either. And TSM is like a dominant player as a chip manufacturer. So yeah, it'll be interesting to see what happens with the stock. Maybe I'll make another DCF evaluation for this company in 6 to 12 months. But hope this was helpful as some friendly reminders, and let me know if you guys have any questions on the chat before I sign off. But as friendly reminders, I'm going to be creating a Discord channel, which as of right now is not ready, but I'll have it in the description at some point, hopefully in the next few days. This model will also be available for free to download soon. And then this is a high-level street-based DCF, a lot of tutorials in the description. You can sign up for my upcoming investment banking course, which I'm hopefully trying to announce in late fall or early winter. And then also as a friendly reminder, if you guys are at all interested in learning more about just the buy-side hedge funds, etc., this investing certificate program between Wharton and Wall Street Prep. They're sponsoring this video, and so if you are interested at all, you can use my code RareLiquid to get $300 off. I talked about it at the beginning, so I won't go through it again, but there's just a lot of great a lot of like great parts to this course in the curriculum where you just learn a lot more in detail, like what you learned right now, but just way more detail basically. So check them out if you're interested. A link will be in the description. That pretty much wraps up the stream for TSMC. I see one last question here in the chat. Is a degree in data science useful in any way in this field of finance? I'd say if you have a data science degree, probably you should go into data science, not investment banking. I think from a recruiter's perspective, they will look at it and see like, oh, this person's comfortable with numbers. They could probably do the job in banking because data science is probably harder. So yeah, useful in that sense. But yeah, thanks guys for joining as always, and I'll catch you guys in the next stream. Peace.